In this video, you will learn on what are volatility indices. I'll be telling you what volatility indices are and how they truly work in the market. So you need to understand how these volatility indices truly work, because that's the major part of this video. And the second one is the best volatility indices for small and big trading accounts. You will know the volatility indexes like you can use for your small account and the one you can use for your big account. They are very, very different. Then on the third one, I'll be teaching you the best volatility trading strategy for volatility indices. This strategy works on all volatility indices, including volatility 75, volatility 51s, which I know is a favorite pair to a lot of you guys. This strategy works on all volatility indices. Now, let's get to it. Alright, so if you're new to Deriv trading, I would say first of all you should go and register your account with Deriv. The link is in the description box below. And before we start this video, I would like to tell you guys about volatility indices, so you truly understand where I'm coming from when I say how to trade volatility indices. Now, the first thing you have to know is that volatility indices are one of the assets provided by Deriv broker. This is their own assets in the market, which means you can only find these assets on Deriv broker alone. They are called synthetic indices. Now, volatility indices are one of a kind when trading. They are one of the best trading assets on Deriv synthetic indices. Why? Because they help us to flow with the market. And a lot of traders are very, very interested in trading these assets. Why? Because they are very easy to analyze, because they move with the real flow of the market. So they move with the trend, they move with the market structure. Almost every trading strategy will work on volatility indices, but it won't be the same thing when you're trading asset like boom and crash. Now, on the chart here, you can see I'm on boom 1000. And if you notice on this chart, you see that this chart is moving much different than the one I showed you guys earlier, which was volatility 25. Now, on this boom and crash, you can see the market moving in a kind of algorithm way. Like if you look at this point, from this point to this point, you see the way the market is moving. And all of a sudden, you get a sudden spike. You understand that, but that doesn't work like that in volatility indices. When you're trading volatility indices, you hardly see spikes like this, and you won't see the market moving in repetitive way like this one. You can see that the market is moving consistently with candles with 0 wicks. You see candles with no wicks, a lot of them on boom and crash. And that's the difference between them. Now look at this movement here. Boom and crash is one of the most desired trading assets on Deriv synthetic indices, but it is also one of the hardest synthetic indices to trade. If you are trading boom and crash, you will make a lot of money, but you need to work consistently with the market to be able to understand boom and crash. You need to get a trading strategy that works really great for boom and crash. Boom and crash has its own special trading strategy, and I'll be teaching you guys in the future videos on this channel, so you guys should prepare for that. Now, since you understand this, now you can see the way this boom and crash is moving. Look at the way it's moving. Just even go back to the previous charts. Look at the movement here. Now compare that with what I showed you guys earlier on volatility 25. Now look at this. Look at the way it is moving. Let me show you another volatility indices like volatility 10. Now look at volatility 10. See the way it's moving in the market. This one moves with more precision. It gives you a better trend movement on the chart, so that you can know exactly what you are doing. And that is the best way to trade the market. You need to understand exactly what you are doing in the market. So you see this now. Now there are lots of volatility indices in the market, and the Deriv has given us a variety of them. Now let me show you some of these synthetic indices on the chart. So when you go down here, you will see volatility indices. This one right here. So you click on it. Although we have this spot volatility, but that one is different. But now this volatility indices, this is the one that I'm talking about. So when you click on it, you are going to see a lot of volatility assets. You can see from the beginning here, we have high frequency volatility 10 index, we have high frequency volatility 100 index, we have high frequency volatility 25 index, we have volatility 50 index on the high frequency. We have a lot of them on the high frequency. These ones are recent assets added to these volatility indices. There was a time that we don't have any of those in the market. But if you go down here, you can see the local ones, the ones that came forth before the other ones that you can see right now. So here we have volatility 10 1s, we have volatility 10 100 1s, volatility 100 15 1s, and a lot of them here. Although all of them are volatility indices, but I don't advise you to trade all of them in the market. So for me, these are the ones that I selected for myself. I trade with volatility indices, but I don't trade all volatility indices because I know the volatility indices that works best for a trader. So the ones that I trade most is volatility 75. I trade volatility 75 1s. I also trade volatility 50, one of my favorite pairs. Assets. I trade volatility 51s, and I also trade volatility 25. Sometimes I do trade 100 1s or volatility 100, but it depends on the account size that I'm trading with at the moment, because some of them are very, very volatile compared to others. When I say volatile compared to others, it means that their lot size is higher than others. For example, let's say we are trading with volatility 10. You can see that the lowest lot size for volatility 10 is 0.5. If you put 0.4 here, it will give you red because it can't go below 0.5. So when you have 0.5 here, let's imagine we are using this candle as an example. Let's say you buy from this point. Let's check how the stop loss will be. So the stop loss, you can use 3.66 as your stop loss. You understand? So, but you can't do this on volatility volatility 51s. Let me show you here. So on volatility 51s, the lowest lot size is 0.05. But even at this 0.05, it's still higher than the lowest lot size on volatility 10. Now let me show you an example. So when you click on this, and you will bring down your stop loss to the lowest point, you can see you are already risking $10 for this little price movement here, using the lowest lot size. Now let me show you why. If you reduce this to 0.04, it won't work out. So that's the lowest lot size. So 0.05 is lowest, but it's still higher than volatility 10, lowest lot size. Now for those of you that have small accounts, this one is very, very good for you. Volatility is 75. The lowest lot size on volatility 75 is 0.01. Now with this loss size, you can trade even with a very, very small account. For example, look at this here. You see, I'm using the lowest lot size now, and I can raise 0.25 cents. You understand? So you are risking very little with this asset, this volatility 75. That's why that's why a lot of traders love derived synthetic indices, because it gives you this opportunity to risk low on your trades. So right now I can risk $0.19 for a trade here. If I increase it to 0.02, it's still not giving me like too much risk on the trade. So I can use this volatility 75 to grow small trading accounts very fast, because it helps me, it gives me that opportunity to trade with the smallest lot size and be able to grow my account steadily in the market. So this is what you guys should be looking out for when trading volatility indices. Now, if you go down to, let's say, volatility 10 1s, volatility 10 1s, even with this lowest lot size of 0.5, it's still very risky compared to volatility 10. So when you have your SL here, your stop loss here, you are already risking 5.93. If this was on volatility 10, you'll be risking, let's say, 3 point something. But right now we are on volatility 10 1s, so you are risking more on your trade. So you have to understand all this before trading these volatility assets. This is very important for you so that you don't go trading every volatility indices and risk a lot of money in the process. So you guys should take this very, very serious in the market. So now that you know all these on volatility indices, let me show you something. So now when you go down to volatility 50, you can see right here that the lowest lot size on volatility 50 is 4. Now, as a beginner, you might think that this lot size is very, very big and risky, but the truth is that it is also very low. You can use this to trade asset that's, I mean, accounts that are very small, like small trading accounts. You can use to trade small trading account. So you can think that this is very, very big as a lot size, but it still gives you very low risk on your trades. So sometimes the lot size can appear big, but it will give you more opportunities to enter the market, and you'll be able to risk less. And sometimes it can be very small but very dangerous. So you have to watch out for some of these things when trading. Before you trade volatility indices, you have to first of all take your time to analyze the risk that is involved in it. You have to understand the major risks that are involved in trading these synthetic indices, especially volatility indices. So some of these assets will help you to grow small accounts, just like I told you guys, which is volatility 75, volatility 50, volatility 10. But if you want to go bigger, you go for trading assets like them 51s, 10. I mean, they are all the same. It depends on the account size you are trading. So it's not like you want to really go bigger like that, but if you want to like trade with much lot size, you can go where you have less opportunity of not being able to change your lot size, and you just want to go big in the market. But if you still want to trade bigger on with the ones with low risk, you can increase the lot size and trade. So it's just like if you have traded currency pairs before, you know that some of the currency pairs are more volatile and risky than others. For example, gold. When you're trading gold, you have no option than to use the smallest lot size, which is 0.1 or 0.01. So but that smallest lot size is very, very risky, and a lot of traders don't like to trade with that smallest lot size, so they go for lower currency pairs. And that's the same thing here. So you have to understand the risk that you're taking for your volatility indices before you start trading them. This is very important before we move to the trading strategy. The trading strategy that we are going to be learning in this video is very, very important for your success with volatility indices. And for we to start learning it, I need to like put you guys through on some things before we start to learn. So, like I told you guys earlier, volatility indices work with the trend in the market. So for you to work with the trend in the market, you have to follow the trend in the market. And there is nothing better than following the trend, even inside the trend. Now, let me show you what I mean. For example, now we are moving in an uptrend here. From here to here, here, you can see we have a lot of higher highs and a lot of lower highs here. And the market is moving in an uptrend. So everyone who sees this chart knows that it is going up. Even if you're a kid, you know that this chart is going up. You know the difference between up and down. So when you do that, when you know as you know the difference now, even inside the trend, you have to be following the trend inside the trend. And what do I mean by that? For example, here. So here we have the market retracing from this uptrend here. This wide uptrend. So the market is retracing. See that the market is retracing here. But now it is going down in a little downtrend. This is a small downtrend. Like if you go down to the 1 minute time frame, you're going to be seeing this as a very big downtrend in the 1 minute time frame. But the truth is that it is not that big as you see it there. If you guys have watched my previous videos, I've told you guys something about rivers, seas, and oceans. So if you see the ocean, you know that the ocean is very, very wide. So it is the ocean that now distributes water to the sea, then the sea now distributes water to rivers, and rivers now start giving it to streams and the rest of them. So that's how it works. The market is broken down into smaller particles based on time frames, and the time frame that you use to trade the market depends on the kind of trader that you are, or what you are really looking for in the market. So right now I'm on the 15 minutes time frame, which is a very good time frame to day trade and scalp the market. So right now you can see that this market is moving down in a downtrend. See the way it's going down, and all of a sudden you see it moving up in an uptrend like this. So for as a good trader that you are, you don't need to follow this tiny downtrend here. You don't want to look for a trading strategy using this tiny downtrend here. You need to work with a major move of the market, which is the uptrend. So when you start seeing the market moving in an uptrend like this, you start seeing it moving in an uptrend like this, that's the point where you start looking for trading opportunities in the market. So at this level where it is moving down, you don't look for an opportunity according to this strategy that I'm going to teach you guys. So you wait for the market to start making moves to the upside before you enter the trade. So that's very important. Now you understand what I mean. For example, if you are in a downtrend, let's say you're moving in a downtrend, you can see that this market is moving in a downtrend. From we have the high here, we have the lower low, and we have the higher low. I mean, so when the market is going down from that point, any retracement it does, you have to understand the retracement and see that the retracement is also now beginning to move in a downtrend, following the major size of the trend, like the major movement of the trend. So you now you look for that type of movement inside the downtrend. So you need a downtrend inside the downtrend. Is very easy like that. It's like when they give birth to you and you are in your family, but and you're now looking like your father. So your father is now the trend, and you looking like your father is you following the trend inside the trend. So now you are in the family and you are now looking like the real family that you're from. I know a lot of family where some of these children don't look like their parents. Maybe they now start to look like their grandfather, their grandmother. They look like other people in the family. Some they look like their uncle. They just take the face of their uncle. I don't know how it happened, but that's just how life is. So for you to follow the trend, you need to look like your father, which is the major trend. That is, if you are in a downtrend, you need to look like the downtrend when it is retracing. The market needs to look like the downtrend when it is retracing. And you as a trader, you only look for downtrends when after the retracement. So when the trend has retraced, you look for a movement that aligns with that same trend in the market. Then you begin to follow it. It's as simple as that. Now, let me go back to the example I was showing you guys. Yeah. So right now that the market is moving in an uptrend here, you can see. So now here the market is moving in a downtrend here. From year to year, you can see there's a little downtrend inside an uptrend because it is retracing. Now, we now as a trader, we can't enter this market when it is moving in a downtrend, which means that, okay, let me get a box here so that I can tell you guys. So all this movement that is inside this box, all this movement that the market is making around this box, we can't trade it. We don't want to trade it because this is going against the main trend. So you might now want to trade the assets. Let's say you wanted to trade it, like you now said, okay, the market has retraced, let me just trade it here. It will end up hitting your stop loss because it is not yet ready to move to the upside. Now let's say for example, now the market is moving at this point. Then you now take a trade here. It's still going to hit your stop loss because the market is not yet ready. But now imagine that after the market has changed direction inside the trend, you see that here we now have a low, we have a higher high, we have a higher low, and we have another higher high. So now these three steps gives you that information that the market wants to change the trend. The market is now moving in an uptrend. So right now, when the market gets to this point, you can now find an opportunity to trade it. You understand what I mean? So when the market is moving in an uptrend, you wait till you see this trend formation. And you all know this trend formation. If you don't know, a trend formation starts from, for example, an uptrend. An uptrend starts with a low, it starts with then another high, then a lower low, then a higher high. I mean a lower high, then a higher high. So when you have this formation already, that's when you start looking for a retracement that works with it. So you can see in a downtrend we have a high, a low, then we have a lower high, then we have a lower low right here. So that's how a downtrend move. Now we're here in an uptrend. So the first thing you do is to get those steps correct. When you get these steps correct, you are halfway into making profits because you are now in a very good stage in the market where the market can where the markets can easily move to your direction. So here you are in a downtrend, and you are seeing a down where you are in an uptrend. So here you are in an uptrend, and you are seeing the market making moves, uptrend moves inside the retracement of an uptrend. So from there you can now look for trading opportunities and trade the market. So for something like this, what you do is that you draw a line at the low. So right here we have the low here, the low of this new uptrend formation. So at this low, this is where you want your market to get to. We have the low here. So now you want the market to break through this low. You can see we want the market to break through this low, to break through this low. So right. So when you have this breaking of the line of the low, so it broke the line, it broke the low, the same thing. Just put your line on the low and you wait for the market to touch that line, at least to break through. You want to see the wicks outside the line. So you don't want to see like the wick just touching it. You want to see the wick outside the line, just like it did here. You want to see it outside. You don't want to have it just inside here. You want to see it outside here. So when you have it outside here, you can now look for a trade. But the thing is that you won't just enter the market and start trading it because you see a candle breaking through the line. So you don't have to trade with every kind of candle that you see in the market. When it breaks through the line, you need to make sure that you are getting the candle that aligns with the trend. So you need a candle that works with the trend. And one of the best candle that works with the trend is the pin bar. A lot of traders know this, that the pin bar is very effective for trend trading. When you're trading with the trend, there are two candles that I recommend. First of all, I recommend the pin bar. And then second, I recommend the engulfing candle. When you are trading with these two candles, you are going to see consistent profit in the market. If you trade with these candles, you will see consistent profit in the market when you are trading with the pin bar or the engulfing candle. For this strategy, I will go with the pin bar because the pin bar works best with this strategy. When you're trading this strategy, use the pin bar. Now, when I say the pin bar, I don't mean getting a bearish pin bar in an uptrend. So, for example, this candle here is a bullish candle. This pin bar you can see here. This one that my line is on right now. This is a bullish pin bar. You can see it here. So in an uptrend, you want to see a bullish pin bar before you can take a trade. If you see another candle which is a pin bar, exactly this size, exact looking like this, but it is now bearish. So for this my chart here, you can see that I use the brown color to show forth my bearish candles, and I use the blue candles to show my bullish candle. So blue color for bullish and brown color for bearish. You can change your own, you can use any color you like, but just understand what you're doing. So right now I have a bullish pin bar here. This bullish pin bar works really great in the market. So I have a bullish pin bar here. So with this bullish pin bar, I can now take a trade from this point and enjoy the market, right along with the market. So right now I can see right now you can see. So let's say I took this trade here. Let's say I took this trade here. I can now place my take profit somewhere here at the top here. But before I start to explain more on that and risk management, guys, let's see another example of this strategy on the chart. So right here we have another example on the chart, and let me zoom out for you to see what it looks like in a bigger view. You need to see from a bigger view to understand what is happening when you zoom down. So right here now I have the market moving in an uptrend. So you can see it here. We have the low, we have the high, we have the lower high, then we have the higher highs then. So this retracement, these retracements here have been done and dusted already. Now you can see, guys, this is what I was talking about when I was showing you this guys, when I was showing you guys the first example. So right here you can see that the market was moving in a downtrend during the retracement, and all of a sudden it start making moves to the upside. So we have a low here, we have a high here, we have a lower high, and then we have a higher high. So the market now came down to this point. You see now around this point you can see, let's see it drew a line there. Let's draw a line here. So we have a line. Let's make sure it's there. So let's say we drew the line there. So here now we are now sure that we want to see a trade because the market is now moving in an uptrend already. Right here we expecting to see a line today. We are expecting to see the markets move to the line already because we already have the uptrend movement here. So we are very sure that the market is going to retrace to it. So now the market has retraced to this line, but instead of giving us some good something, giving us our bullish pin bar, it gave us something bearish, or it gave us a bearish pin bar. So right here, right here we have a bearish pin bar, which I told you guys that it is not good for our trading strategy. We want to see a bullish pin bar for a bullish price movement, and we want to see a bearish pin bar for a bearish price movement. So this in our equation is very, very wrong in the market. So we cannot trade the market around this point. We cannot trade the market around this point because it is a bearish pin bar, which has already almost spoiled our our which has already spoiled our trading setup. So this will not work for us. And when you see the market come down to this point, there was no pin bar again. So even as this market moved from this point to this point, which it moved up later. But if we had followed this pin bar here, we would have lost the trade. It would have hit our stop loss and taken us out of the market. And that would have been a big loss for us. So we have to avoid that by all means. Now, if you take a look at this strategy here, I mean, if you take a look at this setup here, you can see that we have a perfect setup, right? Based on everything that I've taught you guys. So here we have the market moving down in the downtrend as a trend retracement. So it is going down as a downtrend, as a trend retracement, and all of a sudden here we are now beginning to see some uptrend movements. So right now we have an uptrend movement here. We can see the market having a low, have a high, a lower high, and then a higher high. So what does that mean? It means that we can now look for a trading opportunity in the market. So what do we do? Like I said, guys, first of all, we take our line and then we draw it here. Make sure that it is at the lowest point of the candles. So right now we are at the lowest point of the candles. You get it, guys? So now that we are at the lowest point of the candle, we just need the market to break that line a bit. And you can see that after it broke the line, it gave us a pin bar here. It gave us a pin bar here. And with that pin bar, we can now take a trade and place our take profit target at the next high, the last higher high. That's where we'll place our take profit target. So for example, you enter the trade here after this pin bar formed, this bullish pin bar. So you notice that this one is a bullish pin bar. This is not a bearish pin bar like the first one I told you guys, like the one that spoiled in the market. So this one is a bullish pin bar. So it gives us all the assurance to take a trade. So in a situation like this, what you do for me is that you take a trade and you place your take profit target here. I mean, place your stop loss here. You can choose any lot size you want depending on your risk. Let's imagine I want to risk like $40 for this trade. I'll first of all I'll look for the lot size that satisfies my trade. For example, let's say 5. All right, if 5 does not work for me, I'll say 8. All right, now 8 is too much for me. Let's go with 7 and see. Now, if I use 7, I have 37.84 as my risk, which is not too bad. But let's try 7.5. All right, now we have 40.55 as my risk. Let's see, what can I do for my take profit? My take profit should be at the top here. So that means that if I risk $40 for this trade, I'm going to be making $180 as my profit. So this is a very beautiful risk. These are the type of trade that I like to trade. Trades that will give me more profit on my trades. I don't like trades that I will risk $40 and make $50, $60 and all those other things. I need a trading strategy that gives me very low risk and a lot of profits. So right now, as you can see here, you see that this trade is a very profitable one. So you're risking $40 to gain $180. Let's say you're risking $100 on this trade. That will be 300 something. So all right, let's look at it. So we use 7.70 for $40. Let's say we can use 12 for 100. Okay, 12 is still $64. Let's go with 15. 15 is still $81. Okay. 19, what of 19? Okay, well, 19 is $102. Let's say 18.7. Okay, that is $101. I can just risk it like that. So let's imagine I'm risking $100 for this trade. That means I'll be making $449 for the trade. There's no other business in the world that can give you this amount of money in a very short time like this. Look at this here. If you check well, you can see that this movement here is not even up to 4 hours or 2 hours. I don't think it's up to 2 hours. All this movement here, or 3 hours. Let's say 3 hours max. So in 3 hours now, you risk $101 and you're making $449. That is 4 times your risk and more. That is almost 5 times your risk. So if you let's say you risk $1,000, you'll be making $4,490 something for the trade. That's crazy, man. That's massive. That's the reason why I love trading, and I love trading Deriv synthetic indices. They give you very low risk for your trade, and you don't have to worry about the news coming out. You don't know, like, you don't care about that. You just take your trade and look out for your results and outcome. If you do everything right, you have nothing to fear. So that now let me show you another example of this strategy on the chart. And this time around, I want to be going to another indices, so I can show you from another indices. All right, so here we are at volatility 51s, and this is a very big one. This is a big fish. This one you have to like, when you see a setup like this, you first thank God for showing this setup before you even trade it. This is a big one. Now, right here we have the market moving in a downtrend. So we have then lower This is the high, the low, the lower low, the lower high, the lower low here, a lower high, a lower low. Then after all these movements, you can see like after this movement here, the market now started to retrace. The market started to retrace to the upside. So this is the let's first of all mark out the last low before the retracement. So here we have the market moving in an uptrend inside the downtrend. So at this point, we cannot take a trade. We cannot look for a downtrend here. You cannot say, okay, the trend wants to go down again from this point. We need to see something that will give us the go ahead, like, yo, just enter the trade and check the market, like something like that. So we need a very, very serious setup. And this is where I found it. So here the market was going down in a downtrend. So all this uptrend now, their time is over. Their time is over in the market. All these buyers here, their time is over. They can make a lot of money. Let's say their movements can be big in a smaller time frame, like I said earlier, but right here, they're just a little retracement. So after the retracement, you can now trade the major movements on the market, which is the downtrend. So you are looking for a downtrend setup. So here we have a high here, we have a low, we have a lower high, and then we have a lower low here. So that means we can now draw our line at the at this. That means we can now draw our line at this point. Let's make sure that it's on the week. So when we have drawn our line, we now wait to see a pin bar like always. So we wait to see a pin bar. Now this pin bar has appeared here. You can see the pin bar. This is a bearish pin bar. So we are happy that we can see this bearish pin bar here, because it means that we are free to trade the market. This is a go ahead to trade the market. So we don't need to be afraid of anything. Now, since the market is already moving in a way that shows us that it's going to go down in a downtrend. So, and we have the pin bar already. So we can now enter a trade here. So at this point, we are following the same rule, but this time around, we are making more profits from our trade. Now, for example, if you enter the trade here, you place your stop loss at the top here. Now, this stop loss is 0.05. We have $5 risk here, but you want to increase your. For me, let's say I'm using a $100 for this trade. I want to increase my risk to, let's say, 8. All right, 865. Okay, since that is it, let's say 9.5, 95. All right, 95 is 101. Okay, let's take it like that. So your take profit target now should be here. You guys can see your take profit target should be at the low here. And man, this trade is very, very profitable, guys. This is $754 risking $101. So you are making almost going to $1,000 with only 101 risk. Let's say you went down for the smaller time frame. Let's say let's say you get down for the lower risk. Let's say 0.08. Let's say you're risking $10 for this trade. It's okay, 0.09, 9.61. Let's say 9.61 now. let's say you risk approximately $10 for this trade. You are making $71 for the trade as a profit, risking 9.61 as your risk. You'll be making $71 as your profit. That's crazy. Now, let's imagine that you traded with 0.05, which is the lowest lot size. Even with the lowest loss size, which is 5.34 here, you'll be making $39.72. This is the kind of trade. This looks like the kind of trade that we trade on our VIP channel, like the kind of trade that we take on our VIP trading channel. And we always aim to get big profit and very small risk. That's the kind of trade that I take as a trader. I've gotten used to it, and that's how I trade in the market always, because I don't want to waste my time on setups that will not give me profit. I don't like that. I don't like setups that won't give me profit. So I always go for setups that will give me profit in the market. If it's not going to give me big profit, no, there's no use trading it. What if I lose the trade? If I lose the trade now, I'll be losing a lot of money and I'll not be making a lot of money. Like some traders will use $5 to get $10. That's not risk. They are just wasting your time. So if you want to trade, you need to trade with small money and make a lot of money. That's how you progress in trading. Now let me show you another example on another volatility asset, so you see how effective this strategy is on volatility indices. All right, so here I'm on volatility 10, and this is a very good trading setup. So first of all, I have to tell you that the market was moving in an uptrend. So that's the first thing we need to observe before we even look for our setup in the market. So right here you can see that the market is moving an uptrend. Look at the low here, look at the high, then we have the lower high, we have the higher high. It now came here and broke this lower high here. Look at making another lower high. But instead of going down in the downtrend, look at what it did. It went back again and broke the last structure there, which is the last higher high, which means that it's still in an uptrend movement. So it's not yet ready to change direction. The buyers are very strong and they are keeping the market. So right here, this is our point of interest here. So the market came down and make a little downtrend movement. This is a downtrend setup here. This movement here is a downtrend setup. But hopefully the market now went up and created an uptrend setup. This is like a war between the sellers and the buyers. So the sellers did their own here, and the buyers didn't even hesitate to do their own. They just entered their own step ASAP. They did it like fast. Look at it here. Now see the movement here. Look at the movement here. So the buyers are very aggressive at this point and they want to move the market to the upside. But for us to know that they are aggressive, we need to make sure that they follow our own trading strategy. So let's say now that you had this uptrend movement here. I already told you guys what this means. You have a low here, a high, a lower high, then a higher high. So that is uptrend movement. A very strong one. So now we draw our line. We draw our line here. So right now we have our line. Let me check. All right, it's on the week. So there are many things that happened here. Here you can see that the market gave us an engulfing candle. So I told you guys that an engulfing candle is great, but for this strategy, it is best you trade with the pin bar. The pin bar will give you more opportunities, and it's not like this engulfing is going to fail each time it comes to this level. There are sometimes you see an engulfing candle and the market start moving the way it moves when you see a pin bar. So that's how it works. Then right now, after you have seen something like this, you need to still wait for your pin bar because the pin bar is not yet out. So look at all these movements here. It couldn't give us a good pin bar to trade. You understand? There was no good pin bar to trade inside this place. Even this one that looks like it's a pin bar, it's not a good pin bar because the market is not moving in a good structure here. So now that we can see this one, fortunately we now had this pin bar here. So now this bullish pin bar here is now our go ahead to enter a trade. Look at this bullish pin bar here. So when we see a bullish pin bar like this, then we enter a trade and we make our risk management and everything. So let's say you enter a trade here, you now place your stop loss below the pin bar here, like you should, like you should. The take profit target should be at a high here. So let's say you risk $8, you're making $46 for this trade, which is fair. That is more than five times your risk. So let's imagine I increase the lot size to, let's say, 5. If I increase it to 5, that means I'm risking $20 to make $117. So when I have this setup, I this is a very good risk management. I like risk management like this that will give me profit, a lot of profit. Okay, let's imagine I'm risking $100. So if risking $20 we mean me using 5 as my lot size, that means I have to use like 20 for my $100. All right, 20 is too small. It's not 83. Let's say 25. 25 now is 104. I don't want to trade that. I trade 24. I go okay. Now 24 gave me 100.6 something, but I don't care about the cents. Now I have my trade here. If I risk $100 on this trade, I'm going to make $563 for the trade. Can you imagine that? Almost 6 times your risk. Almost 6 times your risk. Can you imagine that? Can you imagine that? Oh my god. Alright. Let's imagine we are risking let's say $200 for this trade. 24 times 2, that is 48. So 48. So I'm risking $200 for this trade. I'll be making $1,127 for my profit. Man, I want you to show me a business that is this good, that is a business that you can scale in one day to this point. You start with a capital of 201 and you end up with 1,127 in a single day. Tell me that business that you do that will give you this amount of profit in a single day, guys. Just tell me in the comment section, guys. It's nothing but forex. Forex is the only way that you can make this amount of profit in a day. Now, let me show you guys type of risk. This is the type of trade. This is the type of trade that I trade in my VIP group. Now, currently I'm on a trade on volatility on jump 50. So look at this trade here. I'm actually risking a lot on this trade. I'm risking $2,282 to make $12,672. And that was because I kind of entered late because I was supposed to enter at this point. But I slept off. I'm talking to you this morning time. I saw this trade in the morning, early in the morning. It's 6 o'clock. Traded this by 6 o'clock, and the trade is still moving. and I want to see how far it goes, and I will be updating you guys in my next video about it. So we trade this type of trades in my VIP group, and there's a lot. Okay, let's imagine you risk let's say $20 for this trade. All right, let me look for 0.2. I don't know. Let's use the limit order. Let's say you were here and you took this trade and you place your stop loss here. All right, let's say you're risking $100 for the trade. Okay, 119 already is too much. 3.5. Let's see. 10.104. Okay, 3.4. 101. Okay, let's go with that. Let's see my take profit target will now give me $626, guys. Even in a late entry, I entered this setup very late. In my own perspective, the way I trade is not normal me, because I'm supposed to enter here. Look at this point here. Let's say I risk my trade from that point here. Okay, let's say um I risk from that point. I mean, let's take it to $100. Uh, 6. All right, 7.6. Oh no, 8. All right, let's say I risk that same amount on this trade in a lower entry, like from this point here, from this point here, I'll be making $1,610. Jesus Christ, $1,610 for the trade, man. I'm bewildered, guys. If you want to join us in our VIP Signal group, the link is in the description box below. And I want you guys, if you are a new trader to Deriv, you can sign up using the link in the description box below. Get your account ready and join us in our VIP Signal group so that we can all make money together. All right, guys. So I will see you guys in the next one. Our next video will be very massive, guys. Don't miss it. I'll see you guys in the next one.